All right, so today's learning target is compare and contrast debit cards, credit cards, prepaid cards, and mobile payment apps in terms of how they work, acceptability, and the cost and benefits associated with each chart. Chris, you made it yet. Okay, types of payments. Obviously, cash, right? We all are familiar with cash, right? So guys, if you're not on this, I want you to take your Chromebooks out, and this is on. Follow along with me. This is on Google Classroom. All right. So cash, we're all familiar with it, right? But we don't. Again, half of us, last time I asked you guys, right? Like half of us had cash, half of us didn't have cash, right? Cash is almost going this thing. It's almost going out, right? The majority of payment types are like mobile, right? Or electronic. Do we still like cash? Do we still like using cash? What do you guys prefer?
Not every time.
Not every time?
I like cash.
You like cash?
Traceable.
Because taxes charge.
So, Dorian, you and Chris are kind of like, you're both right. Now, a lot of cash businesses do this, right? Because, like you said, it's untraceable. Let's say if you have a business, right, and you're accepting payments. If you're accepting mobile payments, well, all payments, you should be paying taxes on it, right? Because the IRS is going to be on you. But a lot of companies, whether legal or illegal, avoid paying taxes by cash payments, right? So sometimes that's why you guys ever walk in a store to go buy something, and they tell you if you pay with cash, you don't have to pay taxes
Yes.
on the product.
Absolutely.
Yeah.
They do that with gas. Basic with cash. You get
Really? They do it with gas?
Yeah. I think use credit cards like a little bit more.
Yeah, I'm not in the gas station. Wow. I know that. Okay. Debit cards. Are you guys familiar with debit cards? If you have a bank account, you have a debit card. Well, you should, if you have a bank account. Right. Okay, there we go. Okay. Debit card linked directly to a checking account. So most of the time you open up a checking account, you're issued a debit card, and when you use the debit card, the money comes directly out of your checking account. So one of the major benefits of using a debit card is you don't have any interest rates, right, with a debit card, and we're gonna compare it versus like a credit card, right? Credit card, you have interest rates, a lot of times high interest rates, right? Debit card, you don't. And also with a debit card, you have ATM access, right? So with a credit card, you can't just go to an ATM and pull money out, right? But with your debit card, since it's linked to your checking account, you can go to an ATM. Sometimes ATM charges you fees, right? And this is another point about commercial banks like we went over yesterday versus credit unions. So my credit union, when I use the ATM, like the ATM, have you guys used the ATM lately? Any of you guys with checking accounts? So when I use the ATM charges me sometimes like $3. I've had an ATM charge me $5 before just for taking money out. But with my credit union account, it gives me that money back. Typically with a Chase account, Wells Fargo, some of these commercial banks, when you get charged that $3 to $5 for taking your money out of the ATM, a lot of commercial banks don't give you that money back. But a lot of credit unions do. It's one of the differences. Okay. credit cards. Again, we've spoken about credit cards, right? And we're gonna go right down to here, because this is what today's lesson is basically about, right? So, one of the drawbacks of having a credit card is the high interest rates. So typically at 19, 18 years old, without any established credit, when you get issued a credit card, you may have an interest rate as high as like 25%. Right? Like, how much is 25%? What's 25% on $100, let's say?
125.
125, right? So if you buy something with a credit card, you pay $100 for it, right? If you don't pay that entire $100 back, you will be charged an interest rate, maybe of 25%, which is 125. That's pretty high. Prepaid cards. Guys, what's a prepaid card? You guys get prepaid cards? No? Never got a prepaid card for your birthday? No, like a card? That's like a, you have Hebron? It's the most you've got on a prepaid card.
Like 25.
$25 prepaid? Then calm. So, benefit of a prepaid card. No debt risk, right? You can only spend what's loaded on the card. Accessibility, it's accessible to, you don't have to have a bank account for a prepaid card, right? And it's a good budgeting tool. Because you know, if you have a $50 prepaid card, you can't spend more than $50 and get yourself in any kind of debt. So one of the only drawbacks to a prepaid card, right? Like you got Hebron, you got a prepaid card for your birthday, right? Let's say if that prepaid card was $25, right? You get taxed. Whoever got it for you, you know who got it for you? Which family member? Your aunt. So your aunt paid maybe $28 for that $25 prepaid card. This came with taxes. Mobile payments. Let's get to these. All these mobile payments you guys may be familiar with. You guys familiar with Zelle?
Yeah.
Zelle, right? Zelle is usually attached to like a banking system, right? I saw something on the news that Zelle might be making some changes. Venmo.
Yep.
Familiar with Venmo? A lot of scamming goes on in Venmo, right? I don't know how, but a lot of scamming goes on in Venmo. PayPal is one of the oldest. Of course, Cash App, right? Square. You guys familiar with Square? Square's a mobile payment system, and Square, let's say if you have a small business, right? You ever buy something from somebody like maybe on the street or something like that, or at the fair or the market, and they have like a little thing that you swipe on their cell phones? Yeah, Square offers that. Square, Google Pay, and most of you guys with Apple, with iPhones have Apple Pay, right? I like these mobile app systems versus cash. I like this versus carrying around cash. You can lose cash. You can lose cash, you can get robbed for cash. Okay. Again, Zelle, bank is needed, and all of these are mobile, Android or iPhone. Okay. So these are your basic mobile systems. You're gonna see some of this stuff on the test, but I think this right here, you guys are all familiar with. It's not too difficult here. So what we want to get into next is this YouTube video about compound interest versus simple interest, right? We've gone over. I think we understand now what just simple interest is, right? Like you spend $100, if you get approximately 5% interest, it's $125, right? You guys know what compound interest is. We've gone over it before. Do we remember? No? I'll take that silence as a no. Video.
that a Prager Station 5?
Yeah, I camped out all month for it.
Wow, doesn't that cost like $350?
What? What's that? That's not a real PS5, right?
The box too small.
Right.
How did you pay for it?
Oh, easy. I just use a credit card.
Ah, well, I hope you pay it off soon or you'll owe a bit more than $350.
Why is that?
Well, there's a thing called interest, usually a certain percentage, charged by lenders when you borrow money, including credit card lenders. Interest covers any risk associated with the loan, but interest can also be earned from saving and investing. Interest mainly comes in two forms, simple and compound. Simple interest is only calculated on the principal, the original amount invested or borrowed. Compound interest, on the other hand, is when the interest is added back to the principal, increasing it, and then the next round of interest is calculated based on that higher principal.
Say that again, but slower.
Alright, let's break it down. Take, for example, a bank that offers you an annual simple interest rate of 6% on a savings account. You deposit $1,000 and then come back a year later. You now have $1,060 in your account. Pretty sweet. The extra $60 is the simple interest you earned over the year, and the principal has remained the same. Now take $1,000 to a bank which offers compound interest. It has the same interest rate of 6%, but this time it compounds monthly. The bank spreads the 6% interest rate over 12 months, and then uses it to calculate the amount of interest earned each month. The interest is then added back to the principal, increasing the principal amount. This process repeats every month. As you can see, the principal grows. You earn interest on your interest. After a year, you would have $1,061.69 in your account. $1.69 may not seem like a lot, but over a longer period of time and with additional deposits, it could be a huge difference.
Really? How?
Use the rule of 72, which only applies to compound interest accounts. Take 72 and divide it by your interest rate, and you get the number of years it'll take to double your money. In our 6% interest example, you would double your $1,000 in 12 years. On the other hand, it would take nearly 17 years to double it in a simple interest account.
That's a difference of 5 years.
Yes it is. Anyway, when it comes to investing, compound interest is better than simple interest. You can't be earning interest on your interest.
So, what kind of interest is best when I borrow money?
Well, when borrowing, simple interest is...
Alright, did you guys get that? The compound, so typically in an investment account, you earn compound interest, right? So it's interest on top of your interest, right? Do we understand that concept? Right, so let's go in simple terms, right? So, let's go to our resident plug, right? Hebron, if you lend me, let's say, $100, right? Lend me $100, I have to pay you back interest. How much interest am I paying you back? How much interest am I paying you back? 2%? Alright. It's generous, right? So it's $2. But for now, for every other day or every other month, right, that I have that $100, right, that you earn not just 2%, we can compound that, right? You can earn $2 and then add $4 and then $6 and then $8. You get what I'm saying? Right? That's typically how an investment account would work, right? That's why it's beneficial. That's why it's beneficial to explore investment accounts when you're young, right? Because are you guys interested in putting $1,000 in an investment account to earn $176 in 10 years? No, right? No, but that's if you just have that same $1,000 in there. But if you add on to that account, right? If you add on money, right? So if you continue to lend me, right? And again, now that if you lend me another $100, Now instead of that $2 from the initial 2% interest, right? Now it becomes $4, and that could double to $8, right? You see how it can grow, right? So the entire point of investing accounts is to continue to invest, right? But one of the keys that we try to help you guys understand that if you do this young, if you do this while you're young, by the time you get a little bit older, your account is going to be looking pretty nice. All right? Consider it. I know it's hard to just have like $1,000 and just put it in an account and forget about it, but it is beneficial.
It's usually best, since interest is only charged on the principal balance. Most often, the balance is paid off in monthly installments. Say you borrow $25,000 to buy a car. The annual percentage rate, APR, on the loan is 5%, and you plan to take 5 years to pay it all back. Your monthly payment is $471.78. Each time you make your monthly payment, part of the payment goes toward the amount of interest that has accrued over the month, and the rest goes toward the principal balance. As the principal reduces, a little less of your payment will go towards interest, and a bit more will go toward your principal balance.
What about my Prager Station 5 purchase?
Well, since you used a credit card, you could be paying interest on interest. Interest compounds daily on any balance remaining past the payment due date. Let's take your $350 purchase and use a typical credit card APR of 20%. That makes your daily interest rate 0.055%, or 19 cents for every day that the balance rolls over past the due date. The next day, you would be charged interest on the new principal of $350.19. This process would continue until the balance is paid off. In just 1 month, you could owe up to an additional $5.82. This may not sound like much, but it adds up quickly. Now that you know how interest works, you can prepare for it in your own finances. There are plenty of online calculators to help you figure out exactly how much you'll be paying or earning once interest is applied to your principal. Shop around for the best rates. Remember, you want low simple interest rates when borrowing and high compounding interest rates when investing. After that, it's all about time. The faster you pay off a loan or credit card, the less interest you end up paying. And the longer you save or invest, the more your earned interest builds up. Interest is going to be part of your financial journey, so be smart about it. Soon enough, you'll be a pro in borrowing and investing, and you'll be making the most out of your money.
Thanks. Maybe I can still return this.
All right. So you guys are not gonna fully understand interest until you get into it, right? Until you start having different types of accounts, right? But do we understand the basics? Interest. Give me a thumbs up if you understand at least the basics.
Yes.
Of interest. You got Marcus?
Yeah.
Good. Daniil? Kingston? Peyton, you still with me? Yeah, a little bit, okay. All right, guys, now what I want you to do is on your Google Classroom. Let's see, I just put it there. Did I not touch it there? All right, let's give me a second. I'm gonna add this to our Google Classroom. Okay, guys, stay with me. I'm gonna add this assignment to Google Classroom, and we'll start working on it together. Yeah, so loan sharks is its own term, right? But yeah, it's usually associated with gambling, and yeah, it's Yeah, it's dangerous. It's dangerous, right? Because like, let's say if you borrow money from a bank, you have to submit an application, they evaluate your credit and your basic ability to pay back, right, Chris? With a loan shark, you're just borrowing money from someone who doesn't care if you have the ability to pay back, or from a group, a company who doesn't care if you have the ability to pay back. They're gonna want their money back. And, you know, that can get dangerous, sticky.
It's like a boss, like a team that comes to your house, right?
When they come to your house, I don't know exactly how it works in 2025, right? But it's not something that you wanna get into. It is not something that you wanna get into. Guys, log on to this assignment here. Let's start working on this together. 49. Start working on this together, and then I'll let you guys continue on your own. So this is one of the assignments that I'm gonna grade for this unit. Let's log on here, fill out your name, first name, last name, and if there's anything, yep. Okay, and again here, take a look up for me, right? Again here, banks versus credit unions. We just wanna scroll down to here, right? Lower fees and better interest rates for loans and especially savings accounts. But traditional commercial banks, they do offer more options as far as accounts, right? More advanced, yeah, there is, with commercial banks, there is more advanced technology on like mobile apps, but credit unions now are doing a good job of catching up to technology, right? So they all basically have mobile apps and they're pretty advanced. Okay, a title loan. So title loan typically offers lower interest rates, but a title loan, here it says holds vehicles as title as collateral, right? For a title loan, you go in, we always advise against it, but if you're in a situation where you need money, right? A title loan is gonna ask you to turn in your title to your vehicle, right? So if you own your vehicle, and a lot of times, even if you're financing a vehicle, they can obtain your title and hold that as collateral, right? So just in case you default on the loan, they'll take your car, right? So it's kind of risky here. You can end up losing your car in this event, right? But so you want to be careful for these in the future. A payday loan typically offers higher interest rates, requires post-dated checks. You can borrow a few $100s, typically 14-day term, right? So a payday loan, if you need a couple of bucks, you need $500, they're gonna lend you the money. And when you get your paycheck, they're gonna take it right from your paycheck. Hey guys, here, at which one of these institutions would a borrower get the best, meaning the lowest interest rates? What do you guys think? Based on what we've reviewed.
Title loans?
What are title loans again, Lily?
Yeah.
What do you have to give up for a title loan? Your car?
Yeah.
It's car title, right? Typically a higher interest rate.
Actually, credit
What else?
union, you get credit union.
Credit unions? Exactly. Credit unions. Alright. At which one of these institutions would a borrower get the worst, meaning the highest interest rates?
Payday? I think Payday lead.
Yeah. Yep. Good job, I think. Which of these institutions is a non-profit?
Credit union?
Credit unions. Yup. Good job, Chris. You and Isaiah holding this down right now. Which of these institutions must you be a member of to utilize their financial services? Right? So remember yesterday, guys, we went over, for example, my bank, Navy Federal, right? Which you have to know somebody in the armed forces. Some other banks. So I think Peach State is a bank where you have to be like a Georgia resident, become a member. Which one of these? Credit unions. No. All right. Why does a title loan typically have lower interest rates than payday loan?
Oh, we don't finish my other class?
Yeah, because it's pretty long. So we're just getting started on this now. So we got about 7 sections.
Title loan requires more collateral.
Yeah, the first one we said.
Title loan requires more collateral. Yeah, and what's the collateral? What's collateral? Guys, what does that mean? What does that mean, collateral? So if you go, Mr. C, can I borrow $1,000? And I'm like, I don't know. What are you gonna give me for collateral? What do you say?
I'll pay you back twice. Twice as much.
Twice as much is
2,000.
that's technically
The 4,000.
200% interest, right? So that's a high interest rate, right? You're paying me. I'll take it, right? But it's not collateral. What's collateral? Like for example, a title loan, right? We remember what a title loan is. We just went over it, right? So a title loan, what do you have to give up? Think about it. Hey, what would you give me? What would you give me as collateral for that $1,000? Just to ensure that I'm gonna get my money back.
Oh, I could give you like, or like I can give you like 500, like the first time.
First payment?
Mm-hmm. In
That
case,
would be a direct payment, not exactly collateral. So collateral has to be in the form of something, an object, right? So for a
like,
title loan.
okay, then I'll give you like my dad's chain, like something like that.
Right, exactly. So I give you $1,000, you promise to pay me back in 15 days.
And if you don't, and if I don't, then you break my dad's chain.
I don't break it, right? But I hold on to it, right? I possibly keep it, right? So let's say you go, after the 15 days, you go, Mr. C, I'm not gonna be able to pay you back. You can keep the chain. And I could possibly sell the chain and get more, right? But I would have to evaluate the actual chain, because the chain has to be at least worth 1,000 plus.
Definitely worth 1,000 bucks.
Definitely worth 1,000 plus, alright? Your dad got the chunky chain?
Nah, you got a really big like chain. We get like diamonds in it and junk.
Oh, really?
And yeah, it's like rose gold diamonds.
Oh, really? Cuban?
I don't be wearing it because I'd be
You don't
my
wear it
house.
out?
I'd be like hung up.
Yeah. He let you wear it?
You said, huh?
Dad'll let you wear it?
No, it's not like my dad right now. It's like my other father. So.
Okay. Alright, got you. Alright. So again, why does a title loan typically have lower interest rates than a payday loan? What do you think? What is it? What's the answer based off of what we just went over? A. Title loan requires more collateral. Alright, let's move down to section 3. Let's work on section 3, and then I'll let you guys continue on your own. Okay, what's click on this link? See, click on the link. That's the video information. Alright, hopefully this link works. Let's try this link. I tried this link before, and it didn't work. Alright, yeah. Oh. Okay.
Some aspects of credit can feel confusing. Anyone who's ever applied for a car loan, a mortgage, or a credit card has probably seen the term annual percentage rate, or APR. Understanding what APR is and how it's calculated may help you make a more informed choice when exploring your credit options. Generally, for credit cards, the APR is the same as the interest rate charged annually on your outstanding balances. When we talk about mortgages or car loans, the APR is likely to include the interest rate plus any fees and costs associated with the loan. But for credit cards, the APR and interest rate are usually the same. So how is APR calculated? Banks use a formula to determine how much interest you'll pay on any outstanding balances. The rate can be calculated daily or monthly, depending on the card. Be sure to check the disclosures for the specific formula and schedule for your card. Different card issuers have different ways of calculating monthly balance. It's important to take the time to understand what the APR is and how the issuer calculates it before choosing a credit card. And when you get your card, keep good credit card practices, such as don't spend more than you can afford, set reminders to make your payments on time, and remember to review your statement every month.
Okay, quick memory check. What does APR stand for? What is the A in APR? Annual. What is the P? Remember? Percentage, annual percentage rate. Okay, what do you have here? What do you think this, guys? So what's our next answer here? APR represents the price to borrow money. In the case of credit cards, is the same as the interest rates? Maybe fixed. Or variable. Exactly. All of the above. Which of the following is true about APRs, annual percentage rates, and interest rates? APRs are typically lower than the interest rate. Fixed APRs and interest rates change over time. Interest rates don't include fees.
Is it two? Would be.
Fixed APRs and interest rate changed over time. See, based, no, this is kind of, because it can be.
So
Go with D on this one. Let's go with D on this one. That's typically no difference. All of the following are ways to get a lower APR when borrowing money except for how do you lower your annual percentage rate? Pay your bills on time?
Mm-hmm.
Yeah, right? Avoid getting too close to your credit limit? Guys think? Yeah, is that a good way to lower your interest rate? Yeah. Keep building your credit? Think yes? No?
I mean, yeah. I mean, building your credit is like paying these bills, so.
Yeah. The higher your credit score goes, the lower your interest rates go. Apply for many credit cards? No? What do you guys think applying for a bunch of credit cards does to your credit score?
Well, I mean, you're paying the bank money. So.
Do you think it's beneficial? Do you think it's, as far as your credit score goes, because that's gonna be part of like tomorrow's lesson. That's it, right? Credit. If you apply for a bunch of credit cards, does your credit score go up? Does your credit score go down? How does it affect? What do you guys think? It's 50-50, what do you think?
Maybe it goes up.
Credit goes up? Anybody say the same? Can we agree? Marcus, what do you think? You apply for a bunch of credit cards, does it affect your credit positively or negatively? If you apply for a bunch of credit cards, does it affect your credit positively or negatively? What do you think? 50-50? Positive?
Negative.
So, if you apply for a credit card, your credit card score, your credit score will temporarily go down. You get approved for that credit card, you do a good job of managing that credit card, and your credit score goes up. If you apply for multiple cards, month after month, it will continue to bring your score down.
Well,
Why?